Hello everyone, welcome back to our channel. Today we are diving into the complex world of taxation with a focus on TCS or tax collected at source in India. Whether you are a seller or a buyer, understanding TCS is crucial to ensure compliance with tax laws. So let's get started. First, let's understand what is TCS. Tax collection at source or TCS is an additional tax collected by a seller of a specified goods from the buyer at the time of sale. This is collected over and above the sale amount and is then remitted to the government's account. The rules and regulations surrounding TCS are defined in Section 206C of the Income Tax Act 1961. It specifies which goods are subject to TCS. The next is TCS relief for resident buyer. You can avoid TCS by providing a return declaration, that is Form 27C, to the seller. For instance, if a resident buyer in India intends to use the purchased goods for manufacturing, processing, generating power and not for trading, they can provide a return declaration to the seller to be exempt from the TCS. Remember to submit a copy of this declaration to the tax authorities within 7 days from the sale month. TCS on lease, license and contracts. TCS isn't limited to just the sale of goods. It also applies to agreements of lease, license or contracts involving parking lots, toll plazas, mines, etc. In such case, a 2% TCS is collected on the license fee from the parties involved. If you are the one collecting tax, you must obtain a TAN. You will need to quote this number in all your challan, certificates, returns or any other documents related to your TCS transaction. There are two crucial steps the buyer must follow. First, always furnish your PAN to the seller. This is essential for proper tax documentation and ensures that your transactions are transparent and tax compliant. Second, if the total TCS amount collected exceeds 50,000 rupees in the previous year, you need to file this return immediately preceding the financial year in which the tax is required to be collected. And it's crucial to meet the due date of the following return under Section 139(1) of Income Tax Act 1961. Now here's why this is crucial. If you fail to file the return within the specified time frame, the seller has the authority to collect the tax at a higher rate. That's right. It could be twice the specified rate or a 5%, whichever is higher. Non-compliance with TCS rules can have serious consequences. Failure to collect or remit TCS can result in being deemed an SSC in default. Collectors may be subject to interest penalties and even prosecution. It's important to note that there are specific criteria for sellers and buyers when it comes to TCS. A seller is someone with total sales exceeding 10 crores in the preceding financial year, and a buyer includes anyone obtaining goods in sale, auction, tender, or other means. There are certain entities exempted from TCS including central and state governments, embassy or high commission, consulate and other trade representative of a foreign nation. Local authority as defined in Section 10, subsection 20 of the IT Act 1961. Last, person importing goods into India. TCS rates vary for different categories of goods and transactions, and these rates change periodically. These latest rates become effective from April 1, 2022. Here's a quick breakdown. In addition to TCS, there are health and education cess and surcharge. This depends on the payee's status and the payment amount. Sellers must deposit TCS amounts using Challan 281 on or before the 7th day of the subsequent month. Payment can be made at authorized banks or electronically. the serious consequences that can arise if you fail to remit the tax collected at source to the government. First, interest is levied at 1% per month or part of the month for the duration of delay. Second, if you fail to collect TCS when you're supposed to, you might find yourself facing penalties under Section 271CA. And guess what? This penalty can be pretty hefty, equivalent to the amount of TCS that you were supposed to collect. And under Section 276BB, you could face prosecution, and the maximum penalty for this offense is up to 7 years of imprisonment. So it's absolutely crucial to ensure that you are on the top of your TCS obligations. Collectors must submit quarterly TCS returns Form 27EQ electronically to CPC TDS within the specified time. But what happens if you didn't meet the deadline? There's a late filing fee of Rs 200 per day for any delay in filing TCS returns. Moreover, if the delay goes beyond 1 year, you might even face penalties under Section 271H. Here are the due dates of filing TCS quarterly returns and issue of TCS certificates. Remember, these dates are crucial to avoid any penalties or late fees. But what if you made a mistake in your TCS returns? Don't worry, you can file a correction statement to rectify any errors, add, delete, or update the information you have already submitted. TCS may not apply if eligible goods are used for personal consumption or purchased for manufacturing, processing, or productions. Buyers can apply for Form 16, which is an application for lower deduction certificate (LDC) to reduce the TCS rate. The assessing officer can issue this certificate if they deem the buyer's total income justifies a lower rate. The lower deduction certificate is issued online through the Trace portal, which makes the process more efficient and convenient. That wraps up our comprehensive guide on TCS. Whether you are a seller or a buyer, it's essential to be aware of TCS regulations to avoid legal complications. If you found this video helpful, don't forget to like, share, and subscribe for more informative content. Thanks for watching, and we will see you in the next video.